What if the greatest financial risk you'll ever face isn't a market crash, a recession, or a bad investment? What if the most significant threat to your wealth is the very thing you use to generate it, the 3-pound supercomputer sitting inside your skull? We're told that building wealth is a game of logic. Buy low, sell high, diversify your assets, think long-term. It all sounds so simple, so rational. Yet we watch as brilliant people make disastrous financial choices driven by impulses they don't even understand. We see ourselves making the same mistakes, selling in a panic, buying into hype, letting fear and greed steer the ship directly into the rocks. The conflict is clear. There's the person we think we are when it comes to money, logical, patient, strategic, and the person we actually are, impulsive, emotional, and profoundly irrational. In this video, we are going to deconstruct the architecture of our own minds to understand why our brains seem hardwired to sabotage our financial futures. We'll explore the hidden psychological traps, the cognitive biases that quietly dictate our decisions. A cognitive bias isn't a sign of low intelligence. It's a mental shortcut, an evolutionary glitch in our thinking that was designed to keep us alive on the savannah, but now costs us a fortune in the stock market. We are going to expose how these ancient instincts betray us and answer the most important question: can we actually win a war against ourselves? The majority of us operate under a simple, comforting myth. If you are smart and informed, you will make smart and informed financial decisions. We believe in our own rationality. We read the books, we listen to the podcasts, we understand the concepts of compound interest and dollar-cost averaging. The strategy seems foolproof. You invest a set amount of money regularly, over a long period, into a diversified portfolio, and you let time do the heavy lifting. The evidence for this approach is overwhelming, supported by decades of market data. It's the financial equivalent of knowing that diet and exercise lead to good health. But if it's also logical, why does the average investor's return consistently lag behind the market itself? If we all know the rules, why are so few of us winning the game? Consider the market dips of 2008 or early 2020. Logic dictated that these were generational buying opportunities, yet the overwhelming human response was panic, a tidal wave of selling. It's in these moments that a crack appears in the myth of the rational investor. What if the part of you that understands compound interest isn't the part of you that's actually in control when the pressure is on? What if this failure isn't a bug, but a feature of our own psychology? To understand this, we need to look at our financial choices through the lens of a powerful cognitive bias known as loss aversion. First identified by psychologists Daniel Kahneman and Amos Tversky, this principle is devastatingly simple. For the human brain, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Let's re-examine that market dip. You see your portfolio down 10%. Logically, you know it's a temporary downturn in a long-term plan. But your brain doesn't register a percentage on a screen. It registers a threat. That red arrow triggers the same ancient, primal part of the brain that screams, "Danger!" when you hear a twig snap in a dark forest. The impulse to sell, to stop the bleeding, isn't a financial calculation. It's a survival instinct. You're not managing an asset. You're trying to pull your hand back from a hot stove. And so you sell at the bottom, locking in your losses, because the immediate relief from the psychological pain feels more important than the long-term, abstract goal of retirement. This is our first major revelation. What feels like a strategic retreat is actually a surrender to our most primitive fears. Your brain isn't trying to make you rich. It's just trying to make the hurt stop. If our deep-seated fear of loss explains why we sell at the worst possible time, then what explains the opposite, equally destructive behavior? If everything we've said is true, then we cannot ignore the mania of the GameStop short squeeze or the crypto bull runs of recent years. Here, we saw people who were otherwise cautious and logical, throwing their life savings at assets they barely understood, often at their absolute peak. This is the other side of the coin. A catastrophic error driven by an equally powerful cognitive bias. Herd mentality, fueled by the fear of missing out, or FOMO. This instinct is loss aversion's evil twin. The pain of seeing your neighbor get rich from a meme stock feels like you are being left behind, a social and financial death. And so, the same brain that was terrified of losing 10% is now suddenly terrified of not gaining 1,000%. The logic of buy low is drowned out by the roar of the crowd. The impact is a complete system failure. The rational mind is shoved aside, and we make the single greatest mistake an investor can make: buying at the peak of a bubble, just as the smart money is quietly cashing out. If our brain is programmed to panic sell at the bottom and greed buy at the top, what chance do we really have? To answer that, we have to uncover the one bias that convinces us we the special one who can time it perfectly. The real mechanism of self-sabotage is coming up next. It's crucial to understand that these biases don't exist because we are flawed or broken. They exist because they worked. For hundreds of thousands of years of human evolution, following the herd was a brilliant survival strategy. If everyone in your tribe suddenly started running, you didn't pull out a spreadsheet to analyze the situation. You ran. Questioning the group could get you eaten. This instinct is baked into our DNA. We are wired to seek social proof and to fear exclusion. The problem is that the stock market is one of the few arenas in modern life where the herd is almost always running toward a cliff. This isn't a new phenomenon. In the 17th century, the Netherlands was gripped by tulip mania, where a single tulip bulb could be worth more than a house. People sold their homes and fortunes to speculate on flowers, driven by the same herd instinct that drives crypto bubbles today. History doesn't repeat itself, but human psychology does. But I know what you're thinking. What about the success stories? What about the person who did buy that meme stock at the right time and made a fortune? That one brilliant move seems to refute everything we've said. It feels like proof that you can beat the system, that you can outsmart the herd. This is perhaps the most seductive trap of all, and it has a name: survivorship bias. We fixate on the one winner whose story is plastered all over the news, and we completely ignore the thousands who tried the exact same thing and lost everything. Their stories are silent. We don't see the bankruptcies and the shattered savings accounts. We only see the lottery winner. And when we get lucky, and make no mistake, it is almost always luck. We don't attribute it to randomness. We attribute it to our own unique genius. This is the overconfidence bias, and it's the final nail in the coffin. That one lucky win doesn't make you a better investor. It makes you a more dangerous one. Even your greatest triumph was simply a lesson in arrogance, delivered by chance. It was reinforcing the absolute worst habits, convincing you that the rules of rationality and probability no longer apply to you. So let's assemble the full mosaic of self-destruction. The market dips, and loss aversion makes you sell your sound. Long-term investments at a loss. Then, a new, speculative asset starts to soar. Herd mentality and FOMO kick in, and you buy in near the top, driven by stories of overnight millionaires. If you get lucky, survivorship bias convinces you that you're a prodigy, not a gambler. This newfound overconfidence becomes your breaking point. It's the moment the internal tension becomes unbearable. Armed with the belief that you've cracked the code, you take an even bigger risk on the next hot thing, ignoring all the warning signs. You go all in, just as the bubble is about to burst. This is the final, inevitable outcome of a brain left unchecked. Now that we understand the machine is designed to fail, what does that mean for its operator? Is there any way to override this programming? The answer lies in the one final trick our mind plays on us, and understanding it will change the way you see money forever.